Continuing the video, accounting assumptions, we have completed accounting assumptions, right? Now we will move to the next part, that is accounting principles. So here you see accounting entity or business entity principle, then second word is money measurement principle, third is accounting period principle, and fourth is your full disclosure principle. So accounting entities are recorded in the book of accounts from the point of view of business. Remember, business and business person or owner of the business are two different parties. Business is different than its owner. Owner is a kind of a creditor to the business because owner invests his or her capital in the business. So owner is like a creditor to the business. Remember, so this is the accounting entity principle, where it is mentioned very specifically that business and owners are two different parties. Then point number 2 says money measurement principles. Remember, whatever the transactions are recorded, it should be in monetary terms. Okay, if the transactions took place in money form, where the exchange of money is being done, then only it has to be recorded. That comes under money measurement principle. Then third is accounting period principle. Usually business operations are calculated for a period of 12 months, be it either it is a calendar year or a financial year. Calendar year starts from January 1st and ends on 31st December. Financial year starts from April 1st and ends on 31st March. Then full disclosure says that whatever the value of asset and whatever the important details that may affect the stakeholders or the shareholders of the business or the other parties or creditors and outsiders, everything should be disclosed. There should be transparency. Nothing should be hidden. Everything must be transparent. Then you see continuing as materiality principle. Then sixth is conservatism principle. Then seventh is historical cost principle. Eighth is your matching concept. And the ninth is dual aspect or duality principle. So you see here in a materiality principle, what is happening? An item or disclosure is material if it influences the decision of the user. Now who uses the information of financial statements? So here we need to understand those people who are investing their money in a business. They may use a financial statement. They would like to know whether where I'm going to put my money, is that business is running in profit or loss, right? So materiality principle says that disclosure is material. Those important things should be disclosed. Based on that, users may do the decision. For the decision making, every sort of things like the valuation of assets and the liabilities, how much company is in debt, how much it has to pay off the dates, everything should be clearly mentioned. Based on that, decision becomes easy for the user. Then conservatism principle. Conservatism says never expect that business is always going to give you profit. Conservatism says always go for plan B. Plan B, if in case if my business get into any kind of loss, any kind of contingency happens. Contingency means unforeseeable, some forces come that has destroyed my business, or that has destroyed the regular running of my business, or that had hampered the running of my business or operation of my business. So conservatism says we always go for plan B. You should have plan in your idea, in your brain, and you should have that much cover, financial cover with you. Any sort of loss or contingency happens, you must know how to make the provision of those losses. You have to make the provision of the losses for the future. That is conservatism. If you know that this asset is going to useless or becoming useless by coming 5 or 10 years, so start making provisions for the assets. That all you will be studying in the lesson, in the chapters. Remember, whatever the principles we are learning now, based on that, all the chapters coming in your class 11th and 12th you will be following, because these are the basic principles. Based on that, the entire accountancy is working. Then historical cost principle says transactions are recorded at price paid. Whatever the price you are paying while purchasing the asset, say for while purchasing an asset, any machinery, or anything, you paid a price of 2,50,000. It may happen the market values has gone up. Now the market value is showing 3,50,000. So on what price you will be showing in your financial statement? So always remember, historical cost principle speaks whatever the amount you paid to acquire the asset, that amount should be mentioned, should be disclosed. That means if you have purchased the asset for 2,50,000, you have to mention 2,50,000 irrespective of the market value which is showing at 3,50,000. Then matching concept. Matching concept speaks that expenses incurred should be matched with the revenue. Revenue is expenses. Whatever the expenses are being done now, it has to be matched with the revenue. That means expenses are done regarding or in corresponding to some revenue. That is a matching concept. Dual aspect says it's very important. Every transaction has got a two sides. So that two side or two aspect is called debit and credit. One is buyer, another is purchaser. One way your money is going, another way money is coming. So this is a debit and credit. Two sides of any transaction, that comes under dual aspect of principle. Then next you say, lastly we have got only two: revenue recognition and verifiable objective. So revenue recognition says revenue is recognized when the right to receive is established. You recognize the revenue when you say that you have incurred income, when your income becomes due. Due means when you have developed a claim on the income that you will get. Say for you worked for a month, you worked for a person for a month, right? So after completion of that month, your income becomes due. Okay, so here you will say yes, I have a due amount that I will be getting from that person, from Mr. X. So this is your accrued income. So income should be recognized when you have a claim to receive it. It should not happen like this, get without working you are saying, yeah, I have a right to get the income. No, first you have to work, then only you will be able to claim your right on the income. So revenue recognition says revenue is recognized when your right to receive is established. And verifiable objective concept says the transactions should be recorded on the basis of evidence. So whatever the transactions are done, there must be some evidence that supports or justifies the transaction. Some voucher payment, some receipt, something, or kacha bill, anything should be there that justifies that transactions is actually being made. So this is all about the accounting principles. Thank you.